I'm Komal and welcome to HP Wealth Insights, an initiative to simplify investing by HP Private Wealth Advisory. It's the classic tug of war between two voices. One says, be bold, go for stocks. And the other whispers, be safe, choose mutual funds. Who do you listen to when both sound right? The best person to answer that question is you. We are not here to tell you what to do. We are here to guide you to what fits you the best. To help you find the best answer, we've prepared this checklist of key questions. Why not pause the video, take a moment, and answer each question? But we won't stop there. For each question, we'll walk you through what it means for you in terms of your time commitment, emotional discipline, investing behavior, and mindset to help you unpack the real purpose behind each reflection. Investing in direct stocks is an ongoing commitment. It's about dedicating time every week to read financial news, track your holdings, review quarterly results, and stay up to date on companies' announcements. Now, before you rush to answer, let's reflect a little deeper. Can you consistently dedicate 3 to 6 hours week after week, not just when it's convenient, to monitor, research, and manage your portfolio? Are you willing to dive into companies' reports, earnings reports, and news headlines even during volatile conditions? And most importantly, do you have patience and time to act only thoroughly on your market research and not get bothered by market trends, volatility, and market reactions? Because if your lifestyle is already packed or investing isn't your true interest, this level of involvement may eventually feel overwhelming. And that's perfectly okay. Recognizing this now will help you understand the path that you want to take. Eventually, the answer lies with you. Do you enjoy reading about stocks? Does investing and the hard work that comes along with it excites you or stresses you? Investing in direct shares isn't about following the tip or guessing. It's about understanding what's happening with the business through numbers, trends, financial fundamentals. Let's reflect more on this. Can you comfortably read a company's profit and loss statement, balance sheet, and cash flow report? And read it with an intent to understand the health of the company or direction where it's going towards. Can you interpret key financial ratios like ROE, debt to equity ratio, PE ratio, cash flow margins, and interpret to make investment decisions? And can you differentiate between a great company and a great stock? Because sometimes a brilliant company may not be at the right value. If you're unsure, it's completely okay. Financial analysis is a skill that can be acquired through consistent time, focus, and continuous practice. But if reading number is overwhelming for you, then you need to know that mutual funds have experts who do this work for you. Investing directly in stock means keeping up to date with news, policies, earnings, and global events. Are you genuinely curious about news like oil price changes, interest rate changes, new regulations that impact business and markets? Would you proactively follow sectorial trends like the impact of renewable energy on utility sector or how technology is reshaping finance? Because if following market trends and economic cycles, economic shifts, and the cause and effect of economy to market and market to economy becomes too stressful for you, then it can become a chore and unrewarding experience. On the other hand, if you enjoy these economic shifts and market trends and their effect on business, then it can be intellectually stimulating and personally satisfying experience. Now let's look at something more critical. Here is the truth. Markets may fall, markets may rise, sometimes by little, sometimes by a lot. But the ability to manage your emotions during these moments is the single most success factor to determine your success in equity. Can you avoid panic selling? Ask yourself, can you avoid panic selling? How does it make you feel when markets go red? How does it make you feel when news headlines are all negative? Do you feel fearful or do you feel opportunistic? Can you resist the temptation when markets are rallying and everyone is emotionally excited about buying? Because emotional investing is expensive. It leads to buying high and selling low, regretting both. So if you think your judgment could be challenged by emotions, then mutual fund is a better way to go. It will keep you focused and disciplined. But if you think that you can be pragmatic in these moments, then directly investing in stocks is the way to go. Now let's shift gears a bit. Investing in shares without a solid plan is like sailing without a compass. Initially exciting, but risky over time. Let's think about this. Do you have a clearly defined goal of why you are investing? Is it for retirement? Is it for education? Is it for a future goal? Is it a wealth creation strategy? Do you have an asset allocation strategy? Do you know what is your risk appetite? Do you know what is your timeline? And do you know how all these mixes together work in your situation? And if you have a clearly defined plan, can you stick to it no matter what happens to the market? Because direct stock investments need clear goal, focus, discipline, and strategic thinking. So if you prefer a structured, professional, and managed approach that automatically balances your risk appetite, your goals, your timeline, then mutual fund is the way to go. But if you enjoy building, adjusting, fine-tuning your portfolio in accordance with your goals and objectives, then shares could be a rewarding experience. But why not a hybrid strategy that will give you best of both worlds? Core portfolio in mutual funds for stability and compounding, and satellite allocation in direct stocks for conviction, control, and growth. Interesting, right? Why not connect with a SEBI registered investment advisor who can coach you and guide you to resolve such complex dilemmas to make an informed decision for yourself?